Hey, it's Paul Canner. Hopefully you're doing well. As you know, the housing market is kind of crazy. Here's just an example. So yesterday I get a call from a listing agent and it's like, hey, Paul, I haven't spoken to you for a while and looking through some offers. We got 27 on this listing of mine. And I noticed your name. And so obviously I wanted to call. We like working with you. And I just want to make sure that the purchaser, your client, is waiving $25,000 of appraisal discrepancy. Have you sourced those assets? And I said, absolutely, we have. They wouldn't have put the offer in. However, if I said no, they'd say, okay, well, we're going to go to the next offer because it was only a few $1,000s less. I like working with you, but I don't want to go through any hassle with the seller if the appraisal doesn't come in, because you know what? They're offering $25,000 over what I think on the high end the house will appraise for. So this is happening every single week. Typically it happens Sunday evenings and Monday mornings, because the way the market's working right now with supply so short, we're seeing the average days on the market about 3.5. And there's a reason for that, because the houses are being available to view Thursday afternoon or Friday mornings, and offers are being taken Sunday evening, and they're going pending on Monday. So we're going to walk you through an example of what this would mean to my client or my buyer or my borrower that I'm working with. So housing market's just crazy. We have a basic lack of supply. We have a lot of households. We haven't put enough new inventory in there. Rental rates are going up. So is it worth it to pay $25,000 over the asking price? And this is something that I posed to an appraiser. And the appraiser's like, look, these houses are selling probably at fair market value, because remember, the fair market value is what someone's willing to pay for a house. And in these cases, we're having multiple offers. Sometimes, in the 20s, I've been involved in a couple of them that were over 40 offers. And so, the fair market value is, however, per agency guidelines, we've got to use closed transactions. We are allowed to use some sales that are pending, but the problem with using pending sales, nobody knows the actual contract price until it records. So the appraiser is telling me, hey, 6 or 7 weeks down the road, we'd have no problem getting this value. So let's think about it. If I'm a buyer and I wait 6 or 7 weeks and the house price has gone up, now I've got to offer even more, I'm spending more for the house, where 6 or 7 months from now, the house would be at that value for sure without a problem. And I stop paying my $3,000 a month rent without building any equity, not paying any principal down. We don't see, and I think you're going to see this with almost every economist, any significant devaluation or drop of property values in the Richmond market. So I'm going to go through this example with my client. And again, we're having these conversations with folks when we go to application. So here we go. And so I'm going to kind of go right here. You can see I've got all these nice little highlights. The first column right here is where we're paying $475,000 for the house, and it is going to go appraised for $475,000. So the cash to close is $58,196. The payment is $27,8698. Now let's say the appraisal were to come in at $25,000 less, or $450,000. Now look, my client has the option, and they have the cash, where they could put the extra $25,000 in. Hey, that's great. We're just kind of moving forward. Our payment's going to drop a little bit because we're borrowing less money, but they have access to $25,000 less dollars. And hey, even at 5.25% interest rate for 30-year fixed, when inflation is running 8.5%, it's like negative interest rates, like free money. They're paying me to use your money. So let's take a look and see what happens. We're going to leave the loan amount the same, so the cash into the transaction is the same. However, the payment does go up to $28,1548, or $28.50. Now think of the headaches that this person is going to avoid by buying this house and not going into, again, many more multiple options or multiple offer situations, and maybe not finding another house for several months. So let's kind of look at a little bit more of the details here. So we look at the payment breakdown where we started. It has to do with mortgage insurance, or PMI. When a buyer's putting less than 20% down, lender wants some coverage in case the house, the person never make some mortgage payments, they trash the house, they don't go to foreclosure for 8 months, and they just totally, we've seen situations where they've just taken paint, put them on the hardwood floors, they tore out the cabinets, the appliances, holes in the drywall, that powdered concrete down the plumbing pipes. They feel like they're losing the house, even though they never made a payment on it. They're just really pissed about it. So they went through the cost of foreclosing. They have to sell, either pay for the repairs or sell the house at a large discount. They have to pay real estate agent, transaction fees, foreclosure fees. So the mortgage insurance insures the lender against that. But again, in the conventional world, the PMI does drop when your house goes up in value. So in this case, it's probably going to be there for about 2 years, where they're going to pay that extra $28. And then the whole thing's going to fall off and the payment's the same. So now what's happened with my clients is they were able to get in a house. They're no longer paying $3,200 a month in rent and not building any equity. They're paying their landlord's mortgage. They're building equity in that house, and they have peace of mind of finding a house, not taking weeks and weeks and months to find another property. So yes, my advice is guarantee the seller some appraisal discrepancy when you make an offer. It will look good. Have a great day. Bye-bye.